October 1929. The Dow doesn't just dip, it disintegrates. 25% gone in 2 days. Brokers aren't strategizing, they're weeping in hallways. Everyone is dumping everything: stocks, positions, dignity, whatever they can unload before the next number hits. And here's the thing about moments like that. Everyone thinks they know what to do. Hold cash, spread your money around, wait it out. Sounds responsible, sounds safe. It is almost perfectly wrong. Across every major crash in the last 100 years, 1929, 1973, 2000, 2008, 2020, 3 specific investments didn't just survive the wreckage, they won. They compounded while everything else was actively on fire. And the majority of investors ran away from all 3 at precisely the moment they should have been sprinting toward them. One of these was so strange, so counterintuitive, that the man who staked his entire career on it got laughed out of Wall Street for years. Years of being called a crank, a theoretical curiosity. Then, March 2020 arrived. His fund returned 4,144% in 1 month. Let's talk about how that happens. Investment 1 is going to sound wrong to you. And honestly, if it sounds obviously right, you've been paying a level of attention that most people alive never manage. We're talking about long-dated United States government bonds, 30-year bonds, during a financial crisis. Yeah. When markets start collapsing, every instinct in your body fires the exact same signal. Get out. Sell. Liquidate. Go to cash. Flee into a savings account that at least has a number that doesn't move. The idea of buying a 30-year government bond while the economy is visibly coming apart feels borderline delusional. You're locking your money into a promise made by a government that might be struggling to keep its lights on. Here's what actually happened, though. 2008, worst economic collapse since the Great Depression. The S&P 500 fell 57% from peak to trough. 57%. If you had a broad index fund, you watched nearly $6 out of every $10 simply disappear. Meanwhile, TLT, the iShares 20-plus year Treasury ETF, was up roughly 25% during that same window. Positive 25, while stocks lost more than half their value. Go further back? The deflationary depression of 1929 to 1932. Stocks fell 89% peak to trough. A number so catastrophic it still doesn't fully register when you say it out loud. And during that entire stretch, long-dated U.S. government bonds delivered positive returns. Not spectacular, not champagne-popping, just positive. In a world where 89% losses were the story, the word positive was the most important word in all of finance. The mechanism isn't mysterious, it's math. When a financial panic hits, 2 things happen simultaneously. First, investors flee anything with risk attached. Stocks, corporate bonds, real estate, anything that could default. They want out. Second, the Federal Reserve, or whatever central bank is staring down a deflationary collapse, slashes interest rates to thaw a frozen system. And here's the relationship that matters. When rates fall, bond prices rise. That's not a theory, it's arithmetic. A bond paying 5% becomes dramatically more attractive when new bonds are only offering 2%. And longer-dated bonds, 30-year bonds, are far more sensitive to those rate movements than short-term instruments. The duration amplifies everything. When rates drop hard and fast, long bonds don't just nudge upward, they surge. Ray Dalio's research documents this exhaustively. In deflationary deleveraging events, which is the technical classification for both 2008 and 1929, the central bank's rate-cutting response creates the ideal mechanical environment for long-duration government bonds. The longer the duration, the larger the price appreciation. But here's what financial media conveniently skips. This only works in deflationary crises. Not every collapse is the same animal. The 1970s stagflation? Long bonds got destroyed. Weimar Germany? Catastrophic doesn't cover it. Argentina's 2001 default? Holding government paper denominated in pesos would have wiped you out completely. So the real insight isn't buy long bonds. The real insight is learning to identify which kind of collapse you're actually watching. A deflationary panic? Credit freezing, unemployment spiking, prices falling? That is the specific environment where 30-year U.S. Treasuries transform from the most boring instrument in finance into an actual crisis weapon. They don't just preserve capital, they compound it while the rest of the system burns. And there's a second layer almost nobody talks about. Long-dated treasuries become more valuable as the system itself deteriorates. When institutions fail, when counterparties default, when nobody trusts anybody, where does terrified money go? Into the one instrument backed by the most powerful government on the planet, denominated in the world's reserve currency. It's a self-reinforcing flight to safety that drives bond prices higher at exactly the moments you need protection most. March 2020 confirmed the pattern again. Fastest equity decline in market history by percentage speed. Long-dated treasuries spiked before the Federal Reserve had even announced intervention. Markets priced in the rate cuts before they happened. Investors who owned them didn't just survive the panic, they had capital ready to deploy into equities at the exact bottom of the crash, positioned to catch one of the greatest recoveries in history from a position of strength, rather than desperation. That distinction, strength versus desperation, that's what crisis investing actually means. Not something that holds steady, something that hands you ammunition when everyone else is completely out of bullets. Now, gold. Everyone thinks they know this one. It fills television ads and survivalist forums and dinner party arguments. It has a bumper sticker version of itself that gets repeated constantly. Gold is a safe haven. True. The way exercise is good for you is true. Technically accurate. Catastrophically incomplete. Because the surface-level story about gold gets the mechanism completely wrong, and the mechanism is everything. Gold has no earnings, it pays no dividends, it produces nothing. Warren Buffett has mocked it for decades, a non-productive asset sitting in a vault doing absolutely nothing. He's not wrong about any of that. What he misses is the function. Mark Spitznagel in Safe Haven describes gold not as an investment, but as monetary insurance. You don't buy insurance because you expect to use it. You buy it because the cost of not having it when you need it is total destruction. Gold's job isn't to make you richer in normal times. It's to prevent you from being annihilated in abnormal ones. Here's where it gets genuinely disturbing. Weimar, Germany, 1923. The most meticulously documented currency collapse in modern history. A single gold mark held 100% of its purchasing power from start to finish, while the paper mark fell to 1/14 trillionth of its 1914 value. 1 trillionth. A German professional who'd spent an entire career accumulating paper savings, government bonds, life insurance policies, watched all of it become mathematically worthless. Someone who had converted even a modest portion of savings into gold before the collapse, they were buying entire city blocks of Berlin real estate at the bottom because distressed sellers were trading irreplaceable property for enough cash to feed their families for a week. Then, 1933, FDR signs Executive Order 6102. All Americans must surrender their gold coins and gold certificates to the Federal Reserve. Price set at $20.67 per ounce. Non-compliance carries up to 10 years in prison and a $10,000 fine. The government was not collecting antiques. It was eliminating the one asset ordinary citizens could use to protect themselves from what came next. What came next? FDR immediately revalued gold from $20.67 to $35 per ounce, a 69% increase overnight. Americans who had legally complied received $20.67 and watched the government pocket the entire difference. Anyone who had stored gold outside the banking system, Swiss accounts, overseas depositories, captured the full 69% revaluation. Most people take the wrong lesson from this. They say, see, the government can confiscate gold. The lesson they bury is that the government confiscated gold precisely because it was the only thing that worked. You don't criminalize something that isn't a threat. Now look at the modern pattern. Gold doesn't rise in a smooth, projectable line. It compresses, sometimes for years, sometimes for decades. Then it detonates. The 2000s are the case study. From 2001 to 2011, gold went from roughly $270 an ounce to approximately $1,900, a gain of over 600% in a decade that included two of the worst stock market crashes in modern history. During the 2008 crisis specifically, gold initially fell, down about 25% in the liquidity crunch phase, when institutions had to sell anything liquid just to raise cash. Then, as the Federal Reserve began its unprecedented balance sheet expansion, gold reversed, up 166% over the following 3 years. Silver did even better in that recovery window, 448%. The World Gold Council has documented that gold outperformed in 8 of the 10 worst months for global equity markets since 1971. Not sometimes, not usually. 8 of the 10 worst months on record. The mechanism is monetary debasement. Every major crisis response in the modern era follows the same script. Economy seizes, central bank expands its balance sheet, new money gets created. The supply of currency increases. Every existing unit gets diluted. Gold supply cannot be expanded that way. There is no printing press for gold. Total global above-ground gold stock grows at roughly 1.5% per year for mining, roughly in line with global population growth. When the supply of paper money doubles in 24 months, as it did in the United States between 2020 and 2022, but gold supply grows at 1.5%, the mathematics of scarcity do their work, automatically, without sentiment.
Argentina, 2001. For a decade, the peso had been pegged to the US dollar at exactly 1-to-1, stable, credible, backed by institutional commitment. The IMF agreed it was solid. The rating agencies agreed. Everyone agreed. Until they didn't. When the peg broke in January 2002, the peso devalued 70% practically overnight. Argentines holding dollar-denominated assets or physical gold, fully insulated. Argentines holding peso savings accounts, which the government had also frozen in a measure called the corralito, lost 70% of their purchasing power before the banks even reopened. Gold doesn't require agreement. It doesn't depend on institutional credibility. It functions in the absence of trust in a way that paper instruments simply cannot. That's not a philosophical position. It's a documented pattern across every monetary crisis in the historical record. The third investment is the one almost nobody owns. It's not available in a standard retirement account. Most financial advisors have never recommended it to a single client. The majority of retail investors have only ever encountered it in an academic context, and the man most associated with it spent years being dismissed as a fascinating theoretical curiosity by people who thought they were smarter than him. His name is Mark Spitznagel. He runs a fund called Universa Investments, and in March 2020, 1 month, 31 calendar days, his fund returned 4,144%. Not over a decade, not over a market cycle, 1 month. What Spitznagel trades is tail risk, specifically out-of-the-money put options on equity markets. These are contracts that pay off enormously when markets crash hard and fast. They cost money every month you hold them, premiums bleeding out whether anything happens or not. In normal rising markets, they expire worthless, month after month after month. By conventional metrics, they're losing money the overwhelming majority of the time. That is precisely the point. Understanding why requires throwing out the way most people think about portfolio returns. Traditional portfolio theory says maximize expected return per unit of risk. Sharp ratios, efficient frontiers, modern portfolio theory, all of it built on this framework. The problem is the framework treats gains and losses as symmetrical events. A 10% gain and a 10% loss occupy the same mathematical space in the model. In the real world, they are profoundly different. A 50% loss requires a 100% gain just to get back to where you started. The mathematics of ruin are asymmetric in a way that standard portfolio theory fundamentally cannot capture. Nassim Nicholas Taleb, whose work in Anti-Fragile provides the intellectual foundation here, describes the difference between fragile systems and anti-fragile ones. A fragile system breaks under stress. An anti-fragile system gains from stress. Tail risk hedges are the only mainstream financial instrument constructed by design to be anti-fragile, built specifically to benefit from the exact disorder that destroys conventional portfolios. Here's the arithmetic that should rearrange your thinking. Imagine a tail hedge allocation that costs 3% of its value per year in normal markets, a realistic approximation of long-term option premium costs. But in the event of a 40% market crash, that allocation returns 400% on the deployed premium. If 3% of your total portfolio is in these hedges, you're spending roughly 0.09% of total portfolio value per year on the insurance. In the crash, that 3% allocation becomes 12% of portfolio value gained, while your unhedged positions lose 40% of the remaining 97%, approximately 39% of total value. Net result? A 27% total portfolio loss instead of a 40% loss. You purchased 13 percentage points of protection for a cost that barely registers in calm conditions. But Spitznagel's insight goes further. His peer-reviewed research demonstrates that this modest protection, compounded over time, doesn't merely reduce losses in crash years, it actually improves the compound annual growth rate of the entire portfolio across a full market cycle, because it prevents the catastrophic drawdowns that require exponentially long recovery periods. A portfolio that drops 5% in a crash year recovers in months. A portfolio that drops 50% needs years, sometimes a decade, just to return to its previous high. Every year of compounding that recovery would have generated, gone, destroyed. The tail hedge doesn't just protect you, it preserves the engine that generates your wealth. Michael Lewis told the human version of this story in The Big Short. A small group of investors bought credit default swaps on subprime mortgage bonds, a form of tail risk hedge on the housing market, and spent years being mocked, questioned by their own investors, written off by Wall Street. The cost of being wrong in normal markets was steady, quantifiable losses and significant social embarrassment. Then 2008 happened. Those hedge positions multiplied into hundreds of millions, in some cases billions of dollars. Lewis framed it as a housing story. The deeper story was about the psychology of holding positions that feel wrong for years at a time. Because that capacity, maintaining protection that bleeds slowly in normal markets, paying premiums month after month when nothing happens, that is one of the rarest skills in finance. It requires believing in the historical record more than you believe in the current environment. And the historical record is not subtle. Every single major financial collapse in the last century was preceded by a period of historically low volatility. The VIX was at historic lows before 2008. Valuations were at historic extremes before the dot-com implosion. Argentine economists were publishing papers in 2000 arguing the currency board was structurally unassailable. Germany's educated professional class in 1919 considered hyperinflation a theoretical impossibility. Every single time, the certainty was highest exactly when the risk was greatest. The crowd was most comfortable at precisely the moment the danger was most acute. And the investments designed for disorder, the ones that bleed in calm markets, were most undervalued at the exact moment they were most needed. Not a philosophical observation, a documented behavioral regularity across every financial crisis in the historical literature. The practical barrier for individual investors is real. Institutional-grade tail hedges require options expertise, derivatives access, active management. But the principle translates. Cash managed as deliberate tactical dry powder serves a similar function at lower magnitude. Capital that does nothing in normal markets but becomes a devastating competitive advantage when distressed assets are available at panic prices. The specific instrument matters less than the architecture. Maintain deliberate exposure to assets that benefit from disorder, even when they create drag in calm periods. Because what history actually shows is not that financial crises are rare, extraordinary events requiring unique circumstances to produce. History shows that crises are the rule. The calm periods between them are the exception. And the investors who survive the rule are the ones who prepared during the exception.
3 tools. Long-dated government bonds in deflationary panics. Gold as insurance against monetary debasement. Tail risk hedges for the events the market prices as impossible. None of these are comfortable to hold. Long bonds feel deeply wrong when inflation is running and rates are rising. Gold feels foolish when stocks are making new highs every other week and financial media is mocking the people who own it. Paying monthly premiums on options that expire worthless, watching the cost accumulate with nothing to show for it, that requires a tolerance for discomfort most investors simply do not have. That discomfort is not a bug. It is the mechanism. The entire architecture of crisis investing depends on the fact that the most protective assets are precisely the ones that are most painful to own when protection isn't needed. By the time owning them feels obvious and comfortable, the protection has already been priced in. You buy insurance before the storm, never during it. Benjamin Graham observed that the investor's worst enemy is not the market, not the economy, not the central bank. It is himself, his inability to hold positions that feel wrong for as long as it takes for them to matter. The Roman creditor holding silver in 230 AD believed his wealth was real because it had always been real. The German professional with a life insurance policy in 1921 believed his retirement was secure because it had been secure his entire life. The Lebanese doctor in 2018 believed her bank account was safe because it had been safe for 22 consecutive years. Every single one of them was correct until the morning they were catastrophically wrong. History is not kind to certainty. It is especially brutal toward the kind that has been validated for a long time. These 3 investments are not predictions, they are tools forged from what has already happened, repeatedly across continents and centuries. Every time a government faced an impossible problem and reached for the same lever, the pattern repeated. The outcomes are documented. The only variable that ever changes is whether you believe you're living inside the pattern or outside of it. That question is worth sitting with. If money never learns just gave you a lens you didn't have before, you already know where the subscribe button is. History has all the answers. Most people just never look.